Hello and welcome to another one in our series on OneSource tax provision functionality. Today we're going through the effective tax rate report, which I know is, if you ask most users of the OneSource tax provision software, is probably their least favorite report of all. But, I always kind of go back to what's the purpose of it? And it's really just to break down the impacts on your overall rate. So what runs through P&L? And I always tell folks that even though there are things here that you possibly don't expect to see and maybe would not like to see, if it's on this report, it means that it had a P&L impact somewhere within the provision and therefore is impacting your overall effective tax rate. So I'm not going to spend a lot of time in the software. I have a variety of different reports that I have exported, but just to kind of go through our different options here, we've got our views. You can look at this either in a summary or a detailed view. I'm always fond of doing the detailed view because, of course, when the reports export, they are grouped in different areas so you can get to the summarized level. But of course, if you run it summary, you can never get back to the detail. So my preference is to run things at the detail level. You are able to get the reports if you're running a consolidation or sub-consolidation. You can get a unit breakout of the reports. You can see it either what we call contracted or expanded, and we'll talk about that a little bit later. I'm going to come back to this one last, but you can also get this view in roll-up. So I think the biggest knock against the report is the fact that temporary differences show up on this report. And a lot of people do not expect to see temporary differences, but this report allows you to create a different view from how the report is done. And I will kind of show you what the standard view is. And so you can select to kind of have your own other view if you would like to kind of group different things together. And then from a state perspective, we have a summarized and a breakdown view. And then, of course, you can also choose to run the effective tax rate by different classes. Now, I will tell you that you can get like your overall tax expense and see that. A lot of times, of course, the rate rec is normally reconciling against your pre-tax book income. So if you select a class that doesn't have the pre-tax book income in it, it might look a little bit strange, but you are able to get the report broken down by class. All right, so this rate area on the drop down, group tax versus blended. Most people use the group tax rate. And really what this group tax rate comes from is when you created the data set, one of the things you had to select was what was your rate that you wanted to reconcile against. So I will go down to my YT data set and find it. Then I edit it. Right here, your group rate. So if it's not really 21%, you can change it to whatever your group rate is. But this is where the software and that particular report is pulling from. Okay, so let's just jump right into my reports. So the first one I am looking at is really the effective tax rate with the state contracted. So the way the effective tax rate reports work, starting out with your pre-tax book income, you will see your state section up top. Now, this state section is net of federal benefit. As you can see, all the things that have a federal benefit calculation on them are broken out separately. So you've got your provision, your deferred, any equity adjustments, and then there's a calculation for the impact of the federal deduction on those numbers. Everything else below is federal only. So that's really key to know. Everything else below is federal only. All right. So the default out of the box is to classify this report in groupings. And you can see I have it grouped here, and that's just standard grouping that came out of the software. And it's by the type of activity. And if you take a look at this and you have been entering data into the software, you will be pretty familiar with that. If we go back to our review and edit screen in data entry, these are our categories that we use to enter data. Perm differences, temp diffs, after tax. After apportionment is your state, but we saw that state was just a summarized view, but tax adjustments and NOL. Those are replicated right here as well. So this is the area that I'm saying if you don't want this particular view, you can create a rolled up view. So let me just hop back into the report and let's just kind of run that with the rolled up view so that we can kind of take a look at that before we delve into the reports properly. I'm going to switch to my rate rec view. And if I collapse these down, you will see I have a variety of different adjustments now instead of the standard how data is entered. I've got, total state and local income taxes. I've got my residual tax on foreign, other tax, stock options, a variety of different things in here. So you can kind of create one that looks the way you would like it to look with the point being that you will still have your temporary differences in, but it will be summarized. As you can see, we've got temporary differences along with NOLs and after-tax temporary differences that go into the change in valuation allowance, and then you can just focus on the subtotals. Okay, so if I go back again, this particular view is state contracted, I mentioned, so it's compressed, but it's also our expanded view. So what this does is it breaks out the report into the rate impacting columns that show up on the deferred reports. And typically, because the state is you will not see anything coming up from the state. This will be just the federal stuff down below. So if I take a look at my 484,855 and kind of pop over, this is coming from my deferred rule, Fed only. And that, as I mentioned, is because on the state side, it is already including the benefit, the federal benefit of state. And this particular view of the deferreds is the income statement view because we want to know what are the pieces rolling through the deferreds that impact the income statement. So you can see the totals here line up with those columns that were on that particular report. The deferred only adjustments and the deferred income tax impact. All right. If you're looking at your perms are going to be tax affected, right? Because remember the perms on the tax provision are pre-tax. So if we were to tax affect each line item and sum them up, we would get to that number. One of the things that's not included is any equity transactions that are within your perms or your tax adjustments. So if we go back and I take a look at my effective tax rate report, there's my 72. You will notice that the description says permanent differences X equity or tax adjustments X equity. So it does not include that. Now, if I go take a look at the state detail view, you will see that if I scroll up, looks similar from the top, but down below has all my state tax items. Now it will have my state tax impact on the pre-tax book income. So if I was to go over to my state provision and tax affect all of these different things, I just did the perms here as an example. So my total perms excluding my equity, this one was my equity. So that includes the state perms that came over from the federal perms and any modifications to those federal numbers, and then tax affected multiplied by my apportionment factor, multiplied by my rate, and then of course multiplied by the federal tax rate to get the net number. That total 2,077,000, that's where that is coming from. So you do the similar thing for any of your other items, but if we take a look at the deferred rate changes and go back over to the deferred rule, we'll also see the same thing. We just have to tax effect those deferreds for federal impact, because in this particular scenario, this data set is actually set up to attach the federal benefit of state to the federal, but the effective tax rate report does not work that way. It attaches a federal benefit of state. Sorry, the federal benefit to the state activity. So that's really important to remember. All right, so there are my subtotals again coming from my net of federal benefit on my state deferreds. Okay, the rest on the federal will look the same as it did on the contracted. All right. You are also able to run the effective tax rate report, as I mentioned, broken up by unit. So in this case, I'm running my consolidated subcon, and this is bringing all of my entities. And of course, this will now get, a little trickier once you start dealing with multiple units, because you potentially have different rates. So here's my group rate again, because this report is actually using the group rate. So what I do want to bring your attention to is this line that's called effective rates different than statutory. So this will populate anytime we have a state, a jurisdiction that has a different rate from what you designated your group rate to be. So here we can see there's a 10% differential. We're calculating at 21%. There's a 10% differential, and this one we've got a 4%, so a negative 10%. So that's telling me that the statutory rate for this entity is lower than our federal, and this one is a positive 4, so that one is higher. But if I pop over to the calculation, oh my goodness, my reference is not valid again. Okay, if I pop over here, you will see that if I calculated my pre-tax book income at the 21%, calculated it at the 11%, which is actually what the statutory rate is, and took the difference, that is what is going to my effective rates different than statutory. And then everything else is the tax effect at the regular statutory rate, and then of course the impact on the book income to get our rate percentages. All right, so the last thing I want to take a look at is what happens when we then run it. Instead of using the group rate, we use the blended rate. You'll notice that the effective rates different than statutory goes to 0. And that's because of the fact that for each individual entity, it's using its own specific rate. So you'll see the one that had a 4% differential is now showing 25%, and the one that had a negative 10% differential is showing 11%. And then what it does is it comes up with an overall blended rate by taking all of the individual tax effects on PTBI and coming up with a 20.89% rate right here. So that's like the main difference between using the blended rate versus the group rate. One last thing to close is that we also have the ability to compare data sets and get an effective tax rate comparison that way. And we can do it when we run the reports. We can also get a breakout by unit when that is run. Okay. Hope you found this information on the effective tax rate report helpful, and I hope that this will make you use the effective tax rate report a little bit more with a better understanding. But definitely get in, play around with it, you can create multiple roll-ups if you would like. And also with the advent of classes and class groups, this can also give you more functionality around the effective tax rate reporting area to kind of create reports that are more useful for explaining different pieces that are rolling through the effective tax rate. Thanks for joining me. Bye-bye.